A lot of the conversations we're having now for people is, where's the opportunity? You know, when people say, how's the market? I say the market's always good for somebody. It's always good. Here's our somebodies that the market's really good for right now. If you have the ability and the time to fix up any properties and you want to be up here doing that, we can find you a deal.
Hey everyone, Chris Lopez here with the Denver Real Estate Investing Podcast. And today we're going to explore the question of, is it a good time to go buy your ski condo or ski house in the mountains? So specifically, we're going to explore Summit County. We're going to talk high-level market trends. We're talking about what's happening with the short-term rental laws. And we're going to dive into two properties and explore what it takes in terms of down payment and cash flow or negative cash flow that you can expect. We're going to explore a 1-bedroom condo in Breck and a 2-bedroom condo in Keystone. So it's a great episode, and I'm joined by Amy Nakos. Amy, good to have you on the podcast.
Chris, great. Thanks for having me.
And to give the official background or the introduction of you, Amy. So Amy runs the Amy Nakos team. She's a team lead up there. And she's also the managing broker at Your Castle Summit, which is her brokerage up in the mountains. And I've known Amy now probably for 6, 7, or 8 years. She's always my go-to for asking about what's going on. Sent a bunch of clients her way. So she is the absolute best resource, and also has the best team I know about in Summit County for people out there. So Amy, I'm excited to dig into the numbers with you today. So walk us back through, we all know, hey, prices went off the charts during COVID. Interest rates have gone up. So where do we sit today in terms of prices and diving into details?
Absolutely, Chris. Thank you for having me. I love being on your podcast because I'm speaking directly to investors, and I love to get into the down and dirty numbers. But I'm going to start a little bit broader first. I'm going to talk about pricing trends in Summit County, and in conjunction with that, who is actually buying these properties. So in terms of pricing trends, what we're showing right now is a chart that we have that tracks average property price and appreciation since 1992. So I took a few notes down here to give me the statistics actually, but in 1992, the average price around $175,000. We're currently at $1.52 million. Since 1992, our percentage increase has been 768%. Who wishes they bought a condo back in 1992? Everybody, right? In 2000, our average price, we're at about $350,000. Interesting. I started working up here in 2003. So in 2000, average price $350,000, 334% increase since 2000. 2020, our average price around $950,000. We've seen a 60% increase when we're here at $1.52 million. So the pricing continues to stay strong, as it does as we've seen in all markets across the nation, right? Pricing in real estate has gone up. In resort markets, definitely went up during COVID. And we're seeing that pricing is holding, which I can talk a little bit more about because there are some exceptions. But I want to talk a little bit broader picture. Who buys these properties? Who is our client? In Summit County, our sales are over 50% of our sales are Denver Front Range people. So most of our market tends to be people who live 70 miles away on I-70, right? Because they've driven I-70 enough to know that they don't want to have to drive I-70. Can you relate?
Oh, all the time. I mean, I was telling you before. So, my wife and I, we have Epic passes for us and the kids. And she's always like, let's go buy a place in the mountains. I'm like, well, are we going to put down $250,000? And that's part of the reason I want you on the podcast, because we don't like to drive to I-70.
Right. So that tends to be, some of our clients. Then about 20% of the sales up here are locals. And then the rest of it. So, if we've got 50 and 20, that's 70. So about 30%. And these numbers fluctuate a little bit, pretty much remains about these numbers, out of state people, with Texas being our largest demographic of purchasers. And then we have Florida, Illinois, and then neighboring states. So that gives you a sense of who's buying most of these properties. Almost all of them are second, third, fourth homes. And why Summit County? Well, we know why. We have ski resorts. We're very close to the ski resorts. We are resort real estate. So the people that can afford these properties, we're going to get into the numbers in a little bit, but we used to have conversations where you could do better on covering your costs for your condo or for your mountain property. And as prices have gone up and as interest rates have gone up, but as rental numbers have stayed pretty flat, the difference between what you can make to cover your costs versus what you're subsidizing has become broader. So we are seeing that it does cost more to subsidize your mountain property. So the demographic of the buyer is somebody who can afford to support a second home or third home.
And then with the interest rates going up, what, 2.5 or I guess 3 years ago now at this point, what's that done to like transaction volume? And then are you seeing opportunities in like houses or condos? So two questions, into that question right there.
So we did see some transaction volume decrease after COVID, but not a lot. I'm telling you that we went back to 2019 numbers and we've stayed pretty steady with the number of transactions. The story, the key difference is the amount of inventory we have. So our inventory has doubled. The amount of properties for which buyers can choose, for buyers to choose from are twice as many as they had previously. So transaction numbers are staying about the same. Average prices are staying about the same. But what we're seeing is median prices decrease, which is showing a little bit of the softening in the pricing, with the average staying high because we've got luxury new construction across the county and very, very high-end homes in Breck, ski in, ski out, and high-end homes. And the uber wealthy luxury sector is pulling up that average. So we're not seeing it in the average. What we are seeing, and I reported this in my newsletter last month, single family homes are staying really strong. Condos are struggling.
I know down here, like Denver, condos are just getting the prices are dropping. How much is insurance and then like wildfire danger causing issues with condos getting insurance or the condo transactions?
Yeah, you hit the nail on the head. It's really the insurance costs that are adding to the HOA fees and bringing those costs up. And it is based on wildfire. It's also based on age of the condos. So we have Summit County was built up in the 70s when the ski resorts started to open. And those buildings that were built back then are really, they're 50 some years old. And so they're getting hit harder with insurance premiums just because of deferred maintenance and the age. Combine that with the wildfire risk, combine that with insurance costs increasing, and also and to get any work done is so expensive. So when you start to factor in, well, we've got this deferred maintenance, or we're putting this capital reserve study together, and a roof, let's just say it was $100,000 5 years ago. It's now $200,000 to do the roof. So all of the factors, you have a perfect storm that's bringing up the HOA monthly costs, which, as we know, pushes down the price.
Are there any condo complexes that can no longer get insurance?
We had, I'm going to say no at the moment, not that I know of, but we had some that were close, and they had to do things like wildfire mitigation, installing sprinklers, retrofitting the building for sprinklers. Yeah. So we have seen some complexes getting close. The other thing we see, and I've heard this, this is not my business. I'm not a property manager, but once you hit a $50 million number in coverage, then it gets really expensive or impossible to obtain insurance. So those homeowners associations are having to figure out what to do with that.
Interesting.
Mm-hmm.
I want to pivot now because I know you prepared two analyses, a place in Breck and a place in Keystone, just to run through the numbers of various options of, some down payment and paying all cash. Let's jump to those. And do you want to start with the Keystone one or the Breck one first so I can pull it up?
Let's start with Breck.
All right, Amy. So I've got the MLS sheet pulled up here that you sent me over a few days before recording this podcast. Just walk us through the location and high level overview of this property, please.
Sure. This is actually my listing. So it's a 1-bedroom, 1-bath in Tyra Summit. So this unit is basically ski in, ski out. Has reserved parking, it has a ski locker, and it has amenities from the Tyra Summit complex across the street, which includes hot tubs and, nice outdoor amenities.
So which peak is this at?
Sorry, what?
Which peak is this at?
So this is up 4 o'clock road. So
Okay.
You're on like the ski hill that comes down this from peak 8.
Perfect. Yeah, I know exactly where it is. Okay.
Yeah, and
Keep going.
And it's near the snowflake lift. So you can get down to the snowflake lift easily. All right. So cute unit. When my clients bought it, they redid the kitchen. So the kitchen's updated. It's got a great little patio there. So for a 1-bedroom, 1-bath, 732 square feet, we're at $779,000, which is about right. Just over $1,000 a square foot for a condo in this location. Recent comp that sold in the last month and a half or so closed at about this price, slightly lower. So that's what we have. The great thing about this condo, it's in zone 1 in Breckenridge, so you can get a short-term rental license. And we can talk more about short-term rental licenses if you want, but this is one of the locations in Breck where you can get a short-term rental license with no trouble. So
let's go and talk about that. I was on my list. You mentioned it because I think a few years ago, Summit County passed some laws. So yeah, fill us in on the different zones and what the short-term rental laws are like up there.
Sure. So I wish it were easy. It's very complicated. So my team and we've actually created an entire article and a guide on this. We thought it would be easy. And I think our guide is 18 pages. So we have 7, I know. In Summit County, there's 7 different jurisdictions that govern short-term rentals. So it depends on where the property lies. You're going to be in one of 6 towns. And if you're not in town limits, you're in Summit County unincorporated. Within Breckenridge town limits, there's 4 zones. So 2 of those zones, Resort and Zone 1, can get short-term rental licenses. This is in town Breck, in Zone 1. We know we can get a short-term rental license. So to go through the requirements of every single jurisdiction is a different podcast that we can do if people really care. But what we do as real estate professionals is when we have somebody come in and say, I need to short-term rent my unit, we parse through and help them understand which properties can get licenses and which cannot, because the address on the MLS doesn't necessarily tell you if it's in town or not. And the maps, if you're just looking on maps, you don't necessarily know where the cutoff is from the town to unincorporated. And you can be in town and get a short-term rental license, be across the street and be in Summit County unincorporated, and you're not getting a short-term rental license. One other quick caveat is there are some homeowners associations that restrict short-term rentals. So regardless of if you're in a zone that allows short-term rental licenses, homeowners associations do have the power to restrict that. So that's another layer of question that we bring in as a real estate professional to say, okay, you found this property, you're in a zone where you can get a short-term rental license. Let's double check that the homeowners association allows it. So it's a pretty in-depth analysis with every single property.
Yeah, that sounds like a lot of work. All right, but this one, ski in, ski out, and you can get a short-term rental, you said, like, relatively easily? Because I've heard of horror stories like a 10 or 15-year wait list. This is just buy, and you could apply and have it within how many days or months?
I don't know how long the process is, but the town of Breckenridge, this would go through the town of Breckenridge, and because it's in zone 1 and there's plenty of licenses, I think you can get it very quickly.
Okay. So no major hurdles there.
Nope. So we can move to the spreadsheets. So this one assumes that we're putting 25% down. So let's say you're coming in and you're going to put 25% down because it's an investment property. So that usually requires 25% down. Getting a loan for the other 75%. And I think the interest rate I put in was 6.5 for these. It's on the page 2 of this, but I think we use 6.5 for these. We also pulled
6.5.
Yeah, we pulled actual numbers the best we could. So taxes are actual. And since this is my listing, we pulled the real income because we know the actual gross income from last year, which was 35,000, 38,000. Hold on. I have glasses on my head for this purpose. 36,000. So what we do with this spreadsheet, took out the real estate taxes, personal property taxes. We put in 500, property insurance, 700, utilities. These are actual. We happen to know it's $1,560. We know the HOA is around 7,000. For property management, we just took 30% of the 36.
And these are annual figures, right?
These are annual. Mm-hmm. We annualize them here. Operating expenses, 22,000. You're making 13,000 on the to help cover some of your costs, but your debt service is $44,000. So you're subsidizing the property to the tune of 31,000 annually. So for some people, that's I don't know what that is a month. 2,800 a month. I don't know.
Yeah, it sounds about right there.
Maybe 27. So, for some people to have that ski condo and to have that available to them, it's worth that monthly cost or it's worth that annual cost. So that's the numbers for that. What I did then is I said, because we've talked about this before, how much money do you have to put down to break even?
Yes.
Right. And so I created the break even Tyra. And this was just trial and error to try to put in the number. So on this one, the mortgage I have is $175,000 to get you about break even. And with that, I think that's 78% down. See, so we're at just negative 174. I didn't make it perfect, but I got close.
Yeah,
so 175 or borrowing 175, 6.5%. So really putting down 78% cash has you at the break even.
Wow. What was it like pre-COVID?
So
remember, what was a rough ratio?
About 50.
Just curious. Wow. Okay.
We were about 50. And when we did a podcast in 23, we did a podcast a couple years ago, and we did 2 Keystone units and we were at 68%.
Yeah. So it's just trending in not in the right direction for looking to buy a place, I'd say, to break even with minimal money down.
Right. Well, interest rates went up and prices went up and rental income has stayed relatively stable. If you go to cash, Tyra.
Yep.
This is just
that pulled up now.
We're just putting down 100% cash. And if you scroll down, it looks like we're making $13,000. And then my number on that, if we're making $13,000, you're making 1.6% on the purchase.
Okay, so to kind of high level, 25% down, what about $200,000 down payment and subsidizing $2,800 a month. Break even is about a $600,000 down payment. To be about cash flow neutral, or pay all cash of about $775 and be cash flowing about $13,000 a year. I'm curious. I don't know if you have a big enough sample size, but for places like this, $1 million price point, are people, where do people fall? Are they putting down 25%? Are they putting down a higher down payment? Are they putting in cash? Where do a lot of your clients or investors fall in at?
So I don't have the numbers in front of me, but what we've actually seen in the last couple years is a lot more cash transactions to the tune of close to 50%, I want to say. So,
Wow.
yeah. And we sometimes I have people putting 25% down. Other times I have people who say, I just want to invest this $500,000. So let's go find a property and I'll get a loan for the rest. So
Okay.
we do see it all over the board, but what I can say is that the change from what I saw pre-COVID, almost everybody had a loan because the rates
And
were so good. Why wouldn't you?
well, yeah, the rates are so good and the cash flow is better, right?
Yeah. Yeah.
All right. What about here in Keystone? I'm gonna pull up the Silver Mill listing.
So what we tried to do here is try to find a couple properties that were within the same price point. So Silver Mill here in Keystone, this is in River Run. This is a 2-bedroom. So $795 to get you a 2-bedroom, walking distance to the slope. So in River Run, but this is the building that's the furthest. The one when you first come in from River Run, it's the building there with the pizza place in it. So 778 square feet, not much bigger than our 1-bedroom, but it's a 2-bedroom, $795,000. And yeah, this
So
go ahead.
what zone does this fall in, or short-term rental zone?
Great question. Keystone is its own town now. Previously, it was Summit County Resort Zone, but Keystone incorporated as a town in the last year. So it's the town of Keystone, and the town of Keystone is basically following the rules that they had before in Resort Zone in Summit County. So there is no restriction on short-term rental licenses. Easy to get one. You're just getting it from now the town of Keystone.
Okay. So you can get one, and relatively easy process to get the permit.
Yes, absolutely.
Okay. So I've actually stayed actually stayed in that building, so I'm really curious to see the numbers on here.
Yeah. So this one, yeah, that's the one, the Silver Mill 8.
So yeah, so we've got 6.5% interest, 25% down, and then walk us through the numbers on here, Amy.
Yeah. So the thing, we'll look at the tax consequences on this one. We didn't on the Breck one, but this one's just the straight up getting in the moment. What are you going to make? And then if you can deduct mortgage interest and take in the tax considerations, that's page 2, which we'll look at in a second. So for this property, we received projected income. This is not my listing. This is just on the MLS, but it's an active listing. So projected income that was attached to the MLS was $45,000 annually. So we know the real estate taxes were $25.48. Personal property, we put in 500 again, that's estimated. Property insurance, 700 estimated. Utilities, all the utilities are covered in this HOA. So in Tyra, we had utilities. Here we don't. HOA is $1,018 a month. So we're at $12,000 annually. And then property management, we took 30% out of the $45,000 for the property management fee. And at the end of the day, this 2-bedroom, 2-bath, you are subsidizing it $30,000, $29,600. The 1-bedroom in Breck was $31,000, pretty close. So I think what this shows us is when you are in a property of about $800,000, you're subsidizing around $30,000 a year.
Okay, that makes sense. Now, I'm glad you brought that up, because we're just looking at, simple cash on cash return or negative cash on cash return. I'm glad you brought up like the other benefits of, real estate ownership. So you mentioned interest deduction, and I assume depreciation. Is that on this
that should
tab
be on
here?
cash flows. Yes.
Okay. So I have not looked in this. Okay. So is it this section right here?
Yeah, at the bottom line, when we get to the very bottom, we were saying it was 30,000 to subsidize it, but then with the tax benefits, it's you're only subsidizing 13,657.
Okay. So, I mean, if you, again, we're not your CPA, so of course, go talk to your
No.
CPA, right? But assuming you can, write it off, get depreciation, it goes from what, about 30,000 a year in negative cash flow to about negative 13,600. So, I mean, that is a
Yes.
significant savings when you look at cash flow after tax benefits.
Absolutely. And we've also seen some W-2 employees, right? W-2 employees always trying to high earning W-2 employees who like this strategy. And again, I'm not your CPA, but they can save money with a short-term rental by writing off the depreciation, by writing off the loss against their W-2 income. Talk to your CPA how you can do that. But we've seen lawyers and doctors take advantage of that and other high income W-2 professionals.
You're talking about that, like, what do they call it? Like that 100-hour short-term rental loophole where they like actively manage it. They can take a lot of depreciation year one.
Yeah.
Yeah, I've seen some case studies on those. Numbers can be very, very powerful.
You should have somebody on who can talk you through that. I'm not the one, but
we've had in the past. Now where my mind goes to is, man, what a cool thing. Go buy up there, live there for a month, handle it, ski, manage the property. That would be a fun thing to do.
Yeah.
All right. So going to the break even.
Mm-hmm.
So brought up this new APOD. So it looks like break even is putting about $600,000 down, or just under $600,000 down for a $200,000 mortgage balance.
Yep. And when I did the math on that, that was putting down 75% as opposed to the 78% on the last one. So again, the numbers are very close.
And I'm curious, I'm going to go to the cash flows tab on this break even one.
Mm-hmm.
And if you, again, are able to write it off, you can actually have positive cash flow after you get the tax benefits. So yeah, lots of interesting plays here you can do as you look at numbers, and also look at how you can, optimize tax saving as well for how it falls on your income.
Yes. And the mortgages you already have. So you can only write off so much mortgage interest. So people who already have a high mortgage don't necessarily qualify for that because they've used up their mortgage interest deduction.
Oh, that makes sense.
I think it's 700, but don't quote me on that.
Yeah. Well, again, talk to your CPA, right?
Talk to your CPA.
So if you pay cash for this Keystone condo, it'll cash flow about $15,500 a year. And then the potential cash flow after tax savings could be $18,000 a year, estimated, of course.
Right. And the 15,000 is 1.9%, so close to 2%. So when we're telling people who are coming into the market and we're saying if you pay cash for a property, you can expect 2 to 3% return on short-term rental income. And so these shook out to be about, a 1.6 and a 1.9.
And earlier you shared, you said about 50% of your buyers were cash. Was that for Breck, or is that kind of like all for Summit County?
All.
Okay. And are most of your transactions, is it heavy Breck, heavy Keystone, or where's kind of distribution spread out on the towns up there?
Yeah. So I think for every broker, it's going to be different. For me personally, I live in Frisco and just have generated a lot of business over the last 22 years here. So I do a lot in Frisco, even though it's a smaller market, and I do a lot in Keystone because I represent a new construction project there. So I'm always showing that, and I tend to get a lot of buyers from that. So me personally, I'm heavy in Frisco, Keystone, Dillon, Silverthorne, some in Breck. Now you're going to find many brokers that are Breck based that really work almost exclusively in Breckenridge because that's our largest market with the highest amount of sales, highest prices. So it really, I'm going to say it's broker specific.
Which complex you represent in Keystone?
It's called the New Seasons at Keystone.
Okay. Is that in the village or?
It's in Lakeside Village, it's called. So
Okay.
it's on Keystone Lake. So it's closer to Mountain House.
Okay.
Yeah.
I ski a lot of Keystone. I'm curious. I'm going up there first time in like 2 weeks to get some early skiing in. I think it's the Kindred, that mammoth thing they're building right at the base of the gondola. What are those units going for?
Well, the units in Kindred started off, I want to say 1-bedrooms were starting in like the high sevens, close to $1 million. And at that point in time, I thought that's crazy. But it depends on the orientation of the unit in which tower they're in. But penthouse went for over $6 million. And I sold a 2-bedroom for $2 million. So there's 2 bedrooms on the market now for $3 million. So it depends on size and orientation, but you can expect the price per square foot at this point to be $2,000 to $3,000.
Wow.
Yeah.
That is higher than I thought it was going to be.
Yeah.
All right. So we have covered, I'm going through our checklist. We've covered high level appreciation trends. We've covered the zoning laws. We covered the Breck and Keystone APODs. What other common questions do you get from, Denver-based potential owners up there? Like, what other talking points are common for you?
A lot of the talking points that we're dealing with right now are, where's the value? Where can we find the best values? Because we have so much inventory and because our transactions are tracking previous years with more inventory. So a conversation we're having a lot is there are probably deals to be had if you're willing to take on a property that's older and needs work. The properties that are in great shape, fixed up, ready to go, turnkey, are selling, and they're selling for the higher prices. They're keeping those prices up. So a lot of the conversations we're having now for people is, where's the opportunity? Because, when people say, how's the market? I say the market's always good for somebody. It's always good, right?
That's such a good answer. Yes.
The market's always good for somebody. And here's our somebodies that the market's really good for right now. If you have the ability and the time to fix up any properties and you want to be up here doing that, we can find you a deal.
How much distress, if any distress, are you seeing up there from, motivated sellers or just issues? I mean, are there distressed properties up there?
Yes, but not in the same way that you would expect it in a primary residential market like Denver. So first, realize that, let's just call it 80% of our owners, these are second or third or fourth homes. They got into it with financial wherewithal to have the ability to afford it. So nobody's, they're not paycheck to paycheck. They're not month to month. So the distress financially, you won't see that. You won't see a bunch of foreclosures like we did in the Denver market, for instance, back in the recession days. What you will see is if people just want out. And I had one of these recently. The property sold for 1.050 in April of 2024. And my client needed to move and we just closed on it. Are you ready for this? $865.
Wow. So that's like what,
last month.
Almost 20% discount?
Yes.
Okay.
Now, that was somewhat of an anomaly because she just said, look, I'm ready to sell. And I said, oh, let's just get it under $1 million and it'll sell. And it didn't. let's get it under 950. It'll sell. And it didn't. And that was because we were just in a market where the condo product, even though it was a beautiful condo, new condo, the condo product was not being absorbed very quickly. So what we had to do there is just chase the market down until we got an offer, which we did at 865. Had she had the patience and could have waited another year or so, I think we probably could have got closer to what she paid for it. So the distress is for people who need out quickly. The option is to be the next sale because of the amount of inventory we have. You just got to undercut the price, and it's got to be pretty dramatic. We're seeing the number about 20% is getting it done.
Wow. And that's more like the condo market and not like the single family? Because I imagine...
It could be the single family home market if it's not in a desirable location and it needs work.
Okay.
So we're seeing it in the single family home market too.
All right. So 2 good opportunities I'm picking up on are condo market where, hey, the seller just wants to get out or needs to get out, maybe a 15, 20% type discount.
Yep.
Or a fixer upper in the single family market. Because those just are, I imagine most people want a turnkey proc when they buy a ski place. Opportunity for a fixer-upper.
Yeah, I mean, think about the second homeowners who are coming in, who can afford these types of properties. They are usually professionals. They have full-time jobs. They live in another city. They have kids in school, and they don't know anybody up here. They don't know any contractors. They don't know who they can trust. So if you are somebody who has that DIY ability, or you know contractors, or you love to fix up places, or it's a project you want to take on, that's where I'm seeing the opportunity right now.
That makes sense. Well, Amy, this has been a phenomenal podcast. I got to make sure that we sync up every single year for the updates. I don't know how I missed 2024, but I will hopefully do a better job of that. But as listeners can see out there, Amy is a wealth of knowledge. If you want more details, go to amynakos.com. Her website has her contact details, her team's contact details. She's a great newsletter. But if you're in Summit County, she is my go-to recommendation for everything real estate up there. Amy, thank you so much for taking the time and preparing all this data for us. We really appreciate it.
Absolutely, Chris. Thank you for having me as always. And really, if anybody has any questions, reach out. My team and I are available, and we dig into these numbers all the time. It's what we're good at. So we're happy to help.
Cool. Thank you. All right, everyone. We'll see you on next week's podcast.